He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement.
Good evening, Mr. Kanwal. Good evening, Mr. Babu.
Business Standard.
Hi Vishal, Ajay here.
Hi, Ajay.
Vishal, are we going to start late or are we going to start on time?
No, exactly on time. So far, all the sessions have started exactly at 4:30.
Okay,
So Tamal will be joining in a couple of minutes.
no problem.
She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard.
Good evening, Mr. Misra.
Good evening.
Good evening. So Tamal sir is joining in a couple of
She
minutes.
has ambitions of becoming a brand. Business
Hi
Standard.
Alok, how are you?
Ajay ji, good evening.
Good evening.
He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard.
হ্যালো কামাল, কেমন আছো?
Yes, sir. Samit da, আপনার video নেই. I can only hear your voice, sir. Videoটা on করুন. Alok is there. Ajay is there.
Namaskar.
Namaskar, sir.
Namaskar, Samit.
Kamal is looking very handsome in a tie and suit, yeah.
I am
He's
actually
making
at
plans
Southern office.
for an early retirement.
I came to Delhi for the Southern inaugural
Business
conference
Standard.
where Rao also, our RBI deputy governor, was there. So then the Lee Meridian office, business Lee Meridian hotel business lounge is full, and then there's no other room. So I made Satish open his office and came here for this.
Great.
Alok is not happy with you.
So anything we need, Ajay, you are not
She
there.
has
Alok
ambitions
also, you are not there.
of becoming a brand.
One second, let me put this phone off. Anything
Business
we need to
Standard.
discuss? Samita was there.
Not from my side.
Okay. Ajay, anything we need to discuss? No.
Anyway, you will do what you want to do. So no problem.
Yeah. So
Steve, can you send him down? I can't hear anything now yet on the.
She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard. He's making plans for an early retirement. Business Standard. She has ambitions of becoming a brand. Business Standard. He's making his investments talk. Business Standard.
Hello everyone. Welcome to the Business Standard BFSI Insight Summit. So far, we've had some of the best minds in the country discuss the Indian economy, cryptocurrencies, and NBFCs. And this session is all about an inside-out discussion on small finance banks. With a keynote speech by former Deputy Governor of RBI, Mr. Gandhi, and this eminent panel. We will take a few questions for the panelists after the initial discussion. Please send them in the questions box on the website. For social media conversations, use the hashtag BS_BFSI. I would now request Mr. Tamal Bandyopadhyay, our consulting editor, to take over.
Thanks, Manish, and hello and welcome to BFSI Big Bang Summit, Business Standards annual event. Good evening, good afternoon, good morning, depending on from whatever geography you are watching us. Today, it's a very, very interesting interesting subject is can our small finance banks make it big? And as we speak, I think the newest small finance bank is almost ready to appear. Any day it will be launched. It's the Centrum Bharat Pay joint venture, which is also taking over a PMC bank. So the segment is in the news, and I understand then there are quite a few investors from overseas, saying Hong Kong, Singapore, UK. They are with us listening to you, the panelists. But before that, as always, we have a very interesting keynote address, and this is slightly different from the previous addresses because this keynote address also has some PowerPoint presentations. Over to you, former Reserve Bank of India Governor, Mr. Gandhi. Thank you, sir. Yours, all yours, sir. Sir, you are on mute. Gandhi, sir.
Thank you, Tamarji. Good evening, everybody. I'm very thankful for Business Standard and Tamarji for inviting me to share my thoughts on this particular topic. First of all, the 5 years before, Reserve Bank granted licenses for a new type of niche banking like small finance bank. And it is a good time. And now that some track record is available, naturally, the interest has started coming up, whether what is the way forward for these small finance banks. So when we talk about the small finance banks, the very thought had come up in the minds of the Reserve Bank of India, basically because of furthering the financial inclusion in the country. Financial inclusion as a serious responsibility has been shouldered by the microfinance institutions, because financial inclusion always was related to the bottom of the pyramid, and microfinance was the center of attention at those times. And the MFIs during the period from post 2000 and 2000s and 2010s, they started exhibiting evidences on the ground that microfinance is a commercial proposition, and through alternative models and data information based alternate models, it will be possible to finance the needy at the bottom level. And another important feature they exhibited was the continuous monitoring of the clients, the customers, doorstep service, and with the use of footloose bankers. That was the concept in microfinance. So then the thought had come whether the success story of the microfinance model, can it be replicated for the small finance? Small finance in the sense that something more than the microfinance. Microfinance is typically a few thousand rupees or 10,000, 20,000 rupees or maximum 50,000 rupees kind of, whereas the small finance, the need for the majority of the population, whether it is businesses or by individuals, they're related to small finance. And these are the people or the businesses who do not have the mainstream banking related documents or properties or securities to be offering. So they also required an alternate model to service them. And that is where the concept of small finance came on the scene. And finally, Reserve Bank announced that it will grant licenses, and finally 10 by institutions got licenses at that point in time in 2016. Now that we are in 2021 and 5 years have gone, let us see with reference before deciding whether the small finance bank can make it further big or whatever. Let us see first in what way the performance of the small finance bank in this 5 years. So that is where we need to look at. So when we look at the performance in these 5 years, I would want to share some PowerPoint presentation, because some slides will be useful to take note of. Just 1 second. Yeah, here it is. So if you look at the small finance banks in these 5 years, how these are all based on Reserve Bank data. We can easily see from the top graph that their total balance sheet, which grew from 27,000 odd crores to 132,000 crores. It is about 4 or 5 times growth in these 5 years. And about one thing that we need to note is that the deposits because that is the first time these microfinance institutions who have converted themselves into the small finance bank, the deposits have started, they were permitted to accept deposits. And the deposit growth also you can see from 5,000 crores to 82,000 crores in this period. And the asset side, when you look at it, that by the loans and advances that had grown from 16,000 or 70,000 crores to 90,000 crores plus. So that's it. But this figure year after year by the SFBs, especially these figures relate to scheduled small finance banks. So the number was not uniform across this period. So it is not really comparable. So what I did was to look at an average SFB, how it has performed in these 5 years. So that's what you can see from here. That brings out the real strength of the concept of small finance bank, where you can see that the capital and reserves had actually grown by 5 times, from 825 crores to 4,600 crores. So more than 5 times it has grown. And if you look at the total liabilities or assets, that's a balance sheet. That is the yellow bar here. That also from 4,600 crores, it has grown up to 13,200 crores per average SFB during this period. Correspondingly, you can see the growth of the deposits and the borrowings. You can see that it has been kind of at a standstill around 3,000 crores all this period, because borrowing had been the usual strength of before they become the MFIs, before they become SFBs. So post they become SFB, deposit has been the main source, and that growth has been from increased from 2,700 crores to 8,200 crores by 2020. The asset side, correspondingly, you can see that the very big growth from 2,800 crores in 2017, now it is 9,000 crores. So the balance sheet of the average bank had definitely 4 times or 5 times it has increased, and the corresponding liabilities and assets have also changed. And if you look at the most importantly, we need to look at the components of the liabilities. That is where the further changes had been taking place, that by the liabilities of the SFBs predominantly were in the term deposits. CASA was there, but the term deposit had been the major attraction for the depositors to grow with. And in the asset side, we had seen that the distinct shift away from unsecured MFI type loans to more and more of secured small finance capital. So that also they were justifying the very logic for which the SFB have been considered. I think. Now to look at how they have performed in comparison with other banks, that is another yardstick we need to look at. Who is the right kind of comparison it can be? Because of, obviously mainstream banks, universal banks, we cannot compare, and even the old private sector banks are, their balance sheet is also quite sizable as compared to an SFB. But the other 2 alternatives will be, one is with comparison with the RRBs. The other is a comparison with the UCBs, that's urban cooperative banks. But urban cooperative banks, the comparison was very, it was not bringing much because their size remains very low. So I made a comparison with reference to RRBs. So RRBs, and during this period, we can see from this graph that by SFBs have almost reached like a normal RRB. This also per RRB size I have compared here. That is by 13,000 crores is the average SFB as of 2020, and the 30,000 crores is the average RRB in our country. So that is in terms of balance sheet size, both of them are on par. Now look at their liabilities and asset size, how there's a big distinction between these two. So SFBs, we can look clearly here that the deposits, the deposits have grown from 800 crores in the from 2017 to 8,000 crores. That is a 10 times growth in this period, whereas the deposits of RRBs, which was at 6,600 crores in 2017, it has reached 10,634 crores. That's the way. But the important point we need to look at is the capital and reserves. The capital and reserves of SFBs have 4 times increased during this period, whereas it is almost remaining flat, hardly from 527 crores, it has reached 770 crores in the case of an average RRB. So the deposits, they are still to grow. SFB, they are reaching near about the RRBs. So they are giving a very good competition there. And look at the borrowing also. The borrowings, as I said earlier, the average SFB maintains that 3,000 crores of borrowing, whereas the borrowing of RRBs are hardly 1,000 crore. When you look at the advances, we can see the big difference again. See, the advances have grown to 9,000 crores per SFB, whereas in RRB, it is 6,000 crores only. So the SFB, the concept as a lender, small finance lender, that has definitely taken deep roots in our country. That's a conclusion we can reach from here. And look at the investment, the RRBs, even though they have got higher deposits, but major part of the deposits, they are keeping it in investment rather than in lending. Whereas SFBs, including the borrowing, including the deposits, they are make good use of the avenue available for them for lending in small finance. So that is a success story of the SFB so far. That as a concept, it has succeeded. That's what I would say. Now on the asset quality. Again, this is based on the Reserve Bank data. There you can see the gross NPS, which I have highlighted here, as compared to the public sector banks or private banks or foreign banks, of course, we look at it. The asset quality of small finance bank is very, very good. So that's again, they have clearly establishes that the concept of small finance is good. We should be going after and supporting institutions who want to do business in small finance by giving more licenses and other things. So that's a quick conclusion we can reach based on this kind of little analysis. Now, when we look at the, because SFBs have converted themselves from MFI, there are certain things in which way the SFBs have transformed themselves. That's what I am showing here. The microfinance institution always had a high NIM and high operating cost, whereas SFBs with a low-cost funding, they could, because they got deposits and low-cost borrowings, they are enjoying the low-cost funding and moderately high NIM. Still, NIM is higher because it is a small finance, and lower interest on deposits in advances also. Say because it is secured credit, so they are offering and higher deposit rates also. That is the higher NIM. A part of it they are passing in favor of the depositors. A part is they are offering to the borrowers, and the other part they retain for their own returns. That's one. Now the basic today's topic is about the big. When we talk about big, in what respect we can think about, in what all respect we can think about SFB becoming big. One, as big as SFB. Other is to become a universal bank. And third is to become a financial conglomerate. What are the chances? And I think that's what I wanted to mention here. This growing big as an SFB looks like very, very possible because of the track record that we have seen so far. So that gives and there is a plenty of scope for the SFBs to be in small finance and being big also. And if you want to grow as a universal bank, then certain minimum criteria you have already reached, as you saw in the basic capital, which is about you are almost reached there, and track record is also available. And once you become a universal bank, you have flexibility in terms of the whether you want to lend in mutual as a microfinance or small finance or large finance, all those flexibilities available in your hands, and you are freed from the own responsibility of 70% PSL. That will also add flexibility to the decision making and the businesses. But along with that, enhanced compliances will be needed. Basel III will be a very big burden, and greater scrutiny will also be there across the board, not just by the regulator, the media, and the general public by themselves. So that is what. And by growing into a big financial conglomerate, I think that is what is the real thing we should be aiming for. Based on your experience in servicing the small finance banks, there is scope for servicing the same clientele in terms of small investment offerings and small insurance offerings. That is the growth path I would suggest for the small finance banks, rather than becoming an universal bank and losing their focus across all type of, because once you are a universal bank, you are supposed to be in all type of businesses, small, big, large, then every type of activity, including forex and other. So all those things will get mixed up, and it may not be a good for a small finance bank who want to play a specific niche role in the economy and grow it big. And that way they'll be able to do service to the stakeholders. This is what I wanted to share with all of you. Thank you very much.
Thank you. Thank you, Gandhi Saab. Yeah, are we back?
Yeah.
Hello. Thank you, Mr. Gandhi. So I wish I knew that you had worked so hard on your numbers and all. I would not have done it. So most of us, what I wanted to say, Mr. Gandhi has already said it. But he has given a very interesting dimension which actually demolishes our premise, the subject that can the small finance banks make it big? I think all of you, hand on heart, you want to make it big and you want to migrate into universal banking, and on some days. You have not come here only for financial inclusion. You are all listed entities. You want to get great valuation and you want to be big universal bank. But Mr. Gandhi is saying that no, I mean, you should stick to the rule book and go for financial inclusion and do well within the small finance bank space. So it will be very interesting to hear what the panelists have to say on that take. Before that, let me introduce the panelists. We could not have a better panel than this. A very interesting mix. We have Suryoday, Baskar, Babu, who is a sort of promoter, founder, and also the CEO. Jana, Ajay, Kanwal, who is the professional CEO, neither a promoter nor a founder, nothing like that. Samit is here as a founder of Ujjivan. Equitas, again, Vasu is both promoter as well as the CEO. Fincare, Rajeev, like Ajay, is a professional. And finally, Alok Misra, he actually has an overview of the industry. He's the boss of MFIN, SRO or lobby group, whatever you call it. So welcome all. We'll have a very interesting, engaging discussion. I don't have much to add, only 2-3 points I would like to add, and these are all basis to Reserve Bank of India paper, recent paper, one on August 17, 2021, an early reflection, and another one on in sometime in February. Okay, so what it says is this: within the small finance bank, you know, there's one entity is disproportionately higher. It's roughly 1/3 of the entire industry, and between two of them actually have some 46% share. So it's very uneven, the size. That's one part I would like to point out. Second is agriculture, trade, and professional services, 65% of the book. So that's another interesting part. And two other parts which are pre-COVID thing, your CASA is low. The so-called current and savings account, which is a low-cost deposits, which is pretty low for all of you. And second is also the NPAs are low. But these two observations are COVID observations. So getting straight to the point, you know, till the appearance of COVID at any small finance banks, the discussion used to be like how you finding it difficult, A, to raise the liability, to build the trust and get people's money. Because giving money is easy because risk is yours, but taking money, collecting money is difficult. And second is the migration from soft touch regulation to full regulation, the compliance issues. But I think since last year, the COVID has changed the challenges completely different. I think COVID is a much bigger challenge than what you would have thought. So the first session I would like to request all of you, starting, I'll go by alphabetically, starting with Ajay. Can you tell us about three minutes each of you? And Alok, you are representing MFIN, you will speak at the end. So even though you are with A, I'm keeping it because you are the industry body. Starting with Ajay, give us, all of you, preliminary remarks, how COVID has treated you, or how you are you up to the challenge, or what is it?
Okay, Tamalda, good evening and good evening to all the viewers and all the panelists. One point of data I Googled while Dr. Gandhi was presenting. The regional rural banks, the first one began in October 1975. So they had a 35-year head start over the SFBs. So I do think that the question of SFBs becoming big is not really a question in like if you use facts or if you use any amount of comparison. And rightly so, because you see all the SFBs, and certainly even if you look at Jana's history, we were a functioning NBFC MFI for the now since 2009. So we have 12 years of history functioning as an organization in the financial services sector. So it's an organization which has scale, has built it over the years. If you look at how Jana's began, and this is, Tamil, you know that well, which is we have 22 states presence, we have 650 branches. That's very unlikely for a startup bank. And that's all credit to where we are from, which is we were functioning large financial institutions before we became banks. I just want to make two comments. One is there is some great uniqueness of being a microfinance institution. And the first one really being that your culture and your training is to be close to customers, being highly connected. And that is part of the discipline that you have to have if you want to run a good microfinance business. Now, if you bring that into banking, which is being very customer-centric, highly connected, and very focused on customers, I do think that you bring a special feature into banking, which most customers would like. Secondly, you can't service a large customer base if you are non-digitized. So we have a very unique combination of being highly digitized, I would say completely digitized. And on the other hand, you have high customer touch. I think these two combinations will certainly make us bigger as we go along. That's an easy one. I think the big question for us at Jana is not about how big we become. Market is very large. I think the most important piece is how good we are. And this is about being best in class. I think we as Jana feel that as a new startup bank, we are 3.5 years old. How can we be best in class in the services we provide? How can we be best in class in governance? And how can we be best in class in digitization? We have no reason not to be because we have a start with no baggage. We have a lot of experiences to learn from other banks, and all of us who work here are from banks, so we know what things we have done in the past, which we should probably avoid in the future. And I must say that the discussion around regulation, to my mind and our experiences, regulation is a positive because it really keeps you on check and make sure you're following the right path all the time. It is work, but I think it is good work. So again, in closing, I would like to say that for us, becoming big is not the most important feature. I think that will naturally happen. For us being best in class in banking, for our consumers on governance, I think how we would think about it.
Thanks, Ajay. But the one thing you missed out, one of the things I would like all of you to tell us, and please take 1 more minute, the COVID phase.
So COVID phase, I think, Tamal, first I must say as an individual, I have never felt that employee safety and health to be as important as I learned during COVID, and that will never escape me. I think digital, we all knew it has forced us to be more digital than ever. I think customer connectivity has been very important because, as you know, there are months where certainly in our business, if you're not connected with customers, getting repayments was very tough. So having that last mile and having that connectivity was crucial. I think strong capital came in as a very important feature. And finally, having a diversified and a secured book, which Dr. Gandhi mentioned that all of us are moving towards, I think again came to fore very much. It's a 1 in 25 year event or a black swan event for sure. So we can't use that and multiply the future. But it certainly has changed us significantly in a few areas, which means that we were aware of digital, but now it has forced us much harder into digital, much harder about employee safety, connectivity, being diversified, stronger on capital. I think it's enforced many things that we knew we were moving towards, but now we know it's like the first priority for everything. Thanks, Samit.
Yeah, we'll get into all these services later. Now, Baskar, your take.
Yes, I think the COVID, pre-COVID.
Yeah, Baskar.
Hello.
Over to you.
Can you hear me?
Hello.
Hello, Kamal, can you hear me?
Yeah, Baskar.
Yes. So pre-COVID.
Yes, I can.
Yeah. So pre-COVID, I think the business was about investing in key four things, which is capital, technology, people, and assets. So we're all addressing each one of that independently, and it was all building up. What COVID probably has done is that it has given a double or triple black swan jerk or a shock, and kind of we were done stress testing on books. What happens if the NPA is 3%, 2%, 2.5%? That Mr. Gandhi was showing. Pre-COVID, it was 1.9% for the entire SFB. So to each institute, depending on the size, the sector they are present, the states they are present. So we had to almost went through a baptism of fire in terms of doing real-life stress testing. What probably saves most of the SFBs is that they were far more capital adequate than it was really required. So the balance sheet side of that and the liquidity as a small finance bank has played out pretty well in terms of us managing. What probably takes off is a year or two, depending on each bank, each SFB, of pre-operating profit to kind of make for provisioning. The good news, however, is that unlike the previous instances where circumstantial default quickly translates into an intentional default for various reasons, this time we aren't really seeing that. You're seeing customers who are even delinquent or not paid anything for the last 6 months coming back and restarting as things are really becoming better. So it takes it back to the focus of what it has done, as Ajay was mentioning, is a digital acceleration in this segment wouldn't have happened at all. This accelerated manner would have taken probably 3 or 4 years, has happened as quickly, which would have been anticipated. It's coming at a cost, it's coming at the cost of profits, but if used well, many of us have really moved in, like Equitas has done extremely well, AU has done, in terms of getting into a segment which otherwise has never happened in the banking industry, which is small ticket secured loans. People have assets, but it's 7 lakhs and 6 lakhs, and they need funding of 3 to 4 lakhs. So probably it is also allowing us to innovate, which probably the earlier one as an MFI turned SFB, any product where the delinquency was initially looked more than 3%, we wouldn't have really attempted. This really kind of enabled us or pushed us rather in terms of attempting all of this. But as we come out of this, probably this year end, or probably in the beginning of next year, the SFBs will make a far stronger impact as the charts even show. But while the discussion goes on in terms of can we become big, I think already we are big in terms of the impact. Closer to around 3% of the Indian households today are served by the SFBs. In terms of assets, probably it is less than 1% in terms of banking balance sheet overall. So that's my comment.
Okay, thanks, Baskar. So next is Rajeev. We'll listen to you.
Yes, Kamal. So if I can, speak about COVID. I guess it's obvious to everyone that's been a phenomenal challenge for everyone. But as it always goes, the challenge has made us, one, stronger, and two, it has taught us a lot of lessons in terms of business management on various aspects, which I'm sure which will be very useful as we grow bigger in our future journey. At a broader level, if I were to break the COVID experience over the last 18 months, one is obviously the liability franchise, the second one is the asset franchise, and the third one I'm just putting it all in one category, which is how the bank has to be built on operations, on digitization, on compliances, and everything else. Very simply, on liability franchise, it has been a boon to almost all banks, and SFBs which were lower on deposits, far lower on CASA ratios, in my personal view, have shown a significant improvement, including CASA, at this point of time, and that's been a great boost to all the small finance banks. On the asset franchise, obviously, the portfolio is broken in two parts. One is the secured part, one is the unsecured part. The unsecured part has played true to its nature, that in a crisis, one, our unsecured is a high-touch model, and two, unsecured tends to have greater losses, but obviously greater margins to also absorb those losses. But what has played out well is in this phase, as Baskar said, our customers have been very good customers. They are paying us, they are coming back, and there has been no real disturbance in the country overall. And it has just been a question of revival of the environment and stability of the environment from lockdowns. Two, a lot of our customers are rural customers, and therefore they are part of essential services. So even in terms of serious lockdowns, their business were less impacted, and therefore the rebound that we typically get in the microfinance portfolio is phenomenal. And lastly, the fact these products tend to grow reasonably fast. So obviously the buoyancy of the growth comes in right after a crisis, and that's what we're experiencing at this point of time. The secured portfolio, to its very nature, generally a low-touch model, and is generally performing quite well on its delinquencies. If I would say on the overall build out of the bank, this phase has given us a phenomenal opportunity, as Ajay said, on digitization, bringing out new tools, stabilizing the compliance of the bank, automating everything. So it's been a tough ride. Assets we have to still solve and manage the NPAs and bring them back to normal. They were very good in the pre-COVID phase, but it's a journey. If there is no wave 3, we should hopefully be, resolving most of our GNPAs over the next 6 to 9 months.
Thanks, Rajeev. Yet another Bangalore-based SFB, Ujjivan. Samit, over to you.
Hi, good evening. What I want to say is that, the birth of small finance banks, we've gone through two major crises. One is the demonetization, and the other is this COVID crisis, which is an unprecedented crisis we've ever faced. And I think this is a testimony to the resilience of small finance banks, that we've gone through both of these crises, without really losing, anything. Obviously, there is going to be a serious credit cost, which we have to cope with. And fortunately, most of us are very well capitalized, from that perspective. And, recovery might take, when the demonetization took place, at least for Ujjivan, it took us about 18 months to completely recover and get on to the track, so it will take some time from a business perspective, but the good news, I think, is, the third wave, given the level of vaccination which has happened in the country, and we did a dipstick study of our customer base in the microfinance. Obviously, other customers have all got vaccinated. But I think about 70% of our customers have got at least one shot of vaccine. And I think over the next few months, with 70% reaching the immunity levels will be fairly easy. I was also a bit worried about, the third wave coming with all these, festivals. And the first festival was, of course, in the East, West Bengal in particular, the Durga Puja, etc. And I believe the COVID levels, were about 70. It's risen a little bit up to about 9. So I think from that perspective, also, it's a good, it's the third wave. So overall, I think, in fact, I was trying to think, Tamal, that you can compare the private sector banks which got licenses, in the 80s or whatever, 70s or whatever, and all of us have survived for about 5 years, and we still continue to survive on an individual basis and do quite well. But if you look back at the GTB and all those others which were given license, many of them, did not survive. So
I think Samit, we are hearing you clearly. So let the backend take care of this. Let's.
Yeah, can you hear me now?
Come on. I think you are having some challenges. Samit, we could hear you quite well.
Yeah. So what I was saying is I was comparing ourselves to the private sector banks which were given licenses in the, what was it, 80s or whatever it is. And many of them disappeared, whereas we are all intact and moving ahead quite well. So to that extent, and having gone through 2 crises, I think that's a remarkable achievement. Kanwal is gone?
Yeah, probably we can have Alok give his comments also.
Right.
Yeah. Hello. Yeah. Let's shift to Vasu.
Yeah. Hi. So the Corona COVID has had a really big impact, without doubt. The demonetization had its own impact, but I think the Corona has had an even bigger impact because it's kind of lasted for a much longer time. The demon was still for about maybe 3-4 months, and then the cost stopped. The effect continued for some more time, but here the cost itself is continuing. And yes, if you see the recent quarter, the second quarter results of some of the large banks which have come out in the last few days, they all had some sterling performances. Almost all of them have come out with probably their historic best performance in the second quarter. And I think that's also a reflection of the kind of customer segment that you are dealing with. You filter and take away all the risk, and you're really focusing on the client base, which is of a very low risk from an individual or retail perspective. While corporates, of course, since the corporates are doing well, so the corporate part of the banking is also supporting them today. But if you look at the SFBs, many of us, I'm not going to say all of us, many of us are in segments where the clients are largely from the unorganized sector, and the unorganized sector customer, the impact of a lockdown is quite severe and dramatic, and full. A guy is running a shop in a bazaar. The shop is not able to be, the shop is not allowed to be opened. What can he do? There's nothing that he can do. His entire income is gone. It's from 100 rupees income, it comes to 0 complete. And this profile of borrowers, since they don't have such a great amount of net worth, they don't have great savings. So there's very little that they can do to repay back during a lockdown. And then they have to slowly rebuild their lives and get back when the lockdown opens. And that's what we are all experiencing. And so the effect on NPA definitely is very sharply higher on borrowers of this profile compared to borrowers of a different profile. So I think we are all looking at it. I'm sure that most of our performances would be better in the second quarter simply because there was no lockdown in the second quarter. Like last year when the lockdowns opened, we all struggled. But by end of March, we are all back to practically the pre-COVID stage in terms of our portfolio quality. So it took us about 6 months to come back with no further lockdowns last year. So this year also, whether it is 3 months, 6 months, or 8 months, or 5 months, it all depends on individual banks. But over that period of 4 or 5 months to 7, 8 months, I'm sure all of us would come back in terms of our quality of assets being back to the pre-COVID levels. So that is something that is a stress on the system. That is a stress on the system, and that has to be handled. That priority has to be quality and not really so much on fresh disbursement. The second thing that COVID has really, kind of fast forwarded is the concern on digital. And I think, even earlier, we all used to use the word digital quite often enough, I believe. But post-COVID, I think we just use it a lot more. And, how much we understand and how much we are geared for it and how much we'll be able to do it. It's all at the, conjecture at this point in time. But clearly, I think the dialogues have become very, very intense, very strident, and very, very, focused on the digital part of it. So what is digital? What do we do in digital? All that depends on each of our own, understanding and take on the platforms. But yes, clearly, I think the COVID has pushed all of us to simply become more aware of the fact that we have to keep talking about digital, and then of course do something about it, but definitely keep talking a lot more about digital. I think that's a significant change that I see that's happened because of COVID. Maybe it's just fast forwarded the whole approach to digital by maybe about a couple of years, which otherwise could have taken a longer time. So I think these are the two main things I would say. Disbursement itself, I wouldn't ever be concerned about, because all of us operate in segments where there's a huge amount of unmet demand for loans from these borrowers. So disbursement and asset growth is the last of the concern for any of the SOBs, in my opinion. So any of us who are comfortable on quality, comfortable on capability and service, we can just get back to business anytime we want. So that's never the concern for us. So it's basically in getting back our quality of assets over the next few months, and this bogey of digital, whatever we do with it. I think these are the two things that we are all for grappling with. Thank you, and back to you. Oh, Tamal is gone again. It got frozen. Bad line from his side.
Alok, why don't you start here?
Yeah, Alok, I think.
Because I think let me wait for half a minute because he might have some different question for me. Otherwise, I can start.
Okay.
Just we'll wait. I think his connection is bad.
Yeah. Yes.
Can you hear, Alok?
Yeah. Yes, I can hear you.
No, I'm sorry. I am facing a very different problem. Every few minutes, it just goes off, and then I bring it back. I am actually sitting at some other place, not my normal place. So I'm sorry about it. It keeps on happening. Probably where I am doing it, there is some issue with this. Every 5-7 minutes goes off, and I'm coming back. So bear with me, and you will continue if you see me off. Alok, we have heard the challenges and also the opportunities from the players, and you give us an industry perspective from your chair.
Okay. So thank you, Tamalda. All the stalwarts have already spoken, and Gandhiji has already given so much of data that not much is there. But I will take it on a different plane in my introductory remarks. Later on, we can, in the other questions sessions, we can come back to it. First, I wanted to say, because when I read that session theme that can these SFBs make it big, I wanted that, can India afford SFBs not becoming big? And why did I so? And why do I say so? Because if you see last week, BCG has released a report which says that we have a stated public policy goal of reaching a 5 trillion economy by such and such date. I will not go into that. But they say for that to happen, it will require an year-on-year growth, GDP growth of 17% in real terms. And for that to happen, the credit growth in the country has to happen at 23 to 25%. And the traditional banks, as Gandhiji in his figures showed, their growth has been stagnant. They have been dragged by legacy. And so the bulk of the work on the credit growth for making India a bigger economy has to fall on the shoulders of SFBs and NBFCs. So SFBs have to, because India cannot afford to do that. And not only on the side, the inclusivity side of it also. Because if the economy becomes 5 trillion, but if the Gini coefficient goes up, and that is not the growth which India will desire for, neither the public policy desires for. And to make it equitable and to make it inclusive, I think SFBs have a big role to play. Now, on the aspect of it, you referred to 2 RBI papers. I had also read them, I think, when they were published. I will not get into them, but I would like to point out a few things which, for me, makes the SFB's experiment stand out. But let me confess at the start that when this SFB licenses were given, I was also on the part of, you can say, veering towards the side of skepticism. But after 5 years, my skepticism has disappeared. I am very bullish on it. Why so? And I have particular reasons to it. One, if you see the numbers, if you say the CD ratio, as Gandhiji in his presentation showed, the low investments and high credit. So the SFBs are not doing lazy banking. They are not just mobilizing deposits and putting it in investment. They are doing lazy banking, not doing lazy banking. And I said, and it is not only not lazy banking, but lending to one of the most difficult sectors which to crack. That is the sector which falls between microfinance institutions and the big banks. The segment which I call as between 2 lakh to 10 lakhs. On the inclusivity side, if you see at the figures, I was looking at the figures, while the target given to them is that 50% of the advances should be less than 25 lakhs. As we say on March 20 data, the last data which RBI has given out, 99.9% of their advances, loan accounts, were for loans below 25 lakh. That shows the size of inclusivity. On technology, all have come, they had the fortune of being born in a technology savvy area, so all are technologically very smart. And that I say from my personal experience and what I hear from my friends, banker friends and all that. I see even earlier people had some reservations on SFBs, but because of their customer centricity and their digital adoption, even retired people who traditionally would look for a public sector bank for safety, but the convenience which is being adopted, that some person visits you at the call and on tab your account is open, you can mature it, you can renew it, people are moving towards that. So that aspect on technology also, they have done a lot of big things. And they have stood their ground, as Samit was saying, on two events back one after the another. 2015 or 16, the SFB started. 16 was demon, though it was not a major event. And now another major event, which is not, I would not say major event, but once in a lifetime event rather. But they have survived well. The asset quality has remained well. And finally, what I would also like to say, because sometimes in numbers and performance, we also miss the softer aspect of it. And when I look at SFBs, especially those who have graduated from MFIs and all in the panel, I have graduated from NBS MFI panel, the leadership, you have to, I would say that if you compare across other financial industry spectrum, the commitment and passion of the leadership, that also has to be factored in. Their passion for inclusive finance, their passion for responsible finance and customer centricity. So on all these parameters, after 5 years and after weathering 2 storms, I think there is no way the SFBs should not, will not become big. They will become big. In what form? Whether as a universal bank or as a conglomerate focusing on the inclusive sector also. I also veer towards Gandhiji's view that I think considering the leadership's passion and the strong track record they have seen, they will go towards that. So I remain very strongly optimistic.
Thanks, Alok. We are getting, I would say flooded with questions. We'll take the questions later, but let's have a quick few rounds. And as I said, I am repeating, there's some technical problem, technological issue from my side. If you see I am off, you continue. I'll get back in 30 seconds. That's what happened twice. Let's talk about, do you think each of you, and don't be diplomatic, the government and Reserve Bank of India, could they have done anything more? One particular issue people are talking about, those whose loans have been restructured, they could not pay. Now, they are not willful defaulters. No, certainly their credit history has gone for a toss. And that's a situation where nobody was, had any control. So can the approach be slightly different to bring them back to the credit market? That's one aspect. And anything else, what do you expect from the government and from the Reserve Bank of India at this point of time when we are hoping that COVID is slowly going behind us? Baskar, and if I'm absent, then you people continue. Maybe 1.5, 2 minutes each. Let's not be diplomatic. What do you want from them? Baskar.
So probably as you rightly said, I think the credit history having got punctured at least temporarily, they need to be brought back into the credit fold. A kind of a guarantee scheme, credit guarantee scheme meaningfully done would go a long way in terms of getting them back into that fold. So currently, while the credit guarantee schemes do exist, they are not meaningfully useful for small ticket loans. So that I think something which we'll kind of look forward to the government to kind of bring them back on track. The other one is that probably access to government and deposits. That we are all in substantially in the financial inclusion business. In the states, wherever each one has got a deep penetration, and as Alok gave the data, around 95% of the entire funding has gone into trade, services, and agri. So probably that way, the liability franchise can be made stronger. We're a lot more cheaper than we are. Probably we are at almost double of what the top 5 private sector banks have in terms of their cost of funds. Whether it's 3.5 and ours would be say 7, closer to that. So probably these are two things which we can do. The rest of it, as Vasu said, the markets are so large. So to each month capability, really we can grow meaningfully. That's the ask. I think is again frozen. So over to Ajay.
Oh, thanks, Baskar. My view is similar to yours. I first must say that, the emergency loan program which the government introduced, the lending to MFIs, very, very helpful. I think what the Reserve Bank did with SLTROs for all of us, the amount of liquidity they allowed the system to have, managing interest rates. So I do think that COVID was not like a playbook played in the past. So good reaction we got both from RBI as well as the government. I think what you're pointing out is real, which is, using Vasu's example, which is, the shopkeeper had his shop closed, didn't have money to pay. Now, when he opens his shop, his first priority would be to borrow some money and, refurbish his goods or get new supplies, start selling those and then pay us, Now, here comes a real challenge, which is he is a delinquent customer or a restructured customer. And the first thing he needs is more money, which will cause a strain on our provisions or the capital that we put up for such lending. So I do think if one can think through where banks really want to extend working capital, and these are restructured accounts or accounts which are not doing well, which means they could be delinquent or NPA, what could we do so that banks don't feel very strained to do it? I think that's in a nutshell. I appreciate Baskar absolutely that if we are in financial inclusion and we are doing the best we can from a commercial perspective for society, getting government deposit would be a great idea. So that's my thought, and I'll pass it on.
Yeah, Rajeev?
From my side, I think it's very obvious that it was a very special crisis and everybody was reacting as per the situation, and the government pretty much did government and RBI combined did 3 interesting things. One was on liquidity side, the SLTRO. The other one from our perspective was the government guarantee schemes of various kinds. We know one of them was the CLGS, there were others which were designed for the NBFC MFIs. And the third thing, the overall restructuring package, which was specifically designed for COVID 1 phase, COVID 2 phases. So a lot was done in this phase. But I think, and obviously the big phase that happened was in the middle was a moratorium, which we initially felt would be very challenging. But when you look in hindsight, I think it played out the best even for the 6 months that was done. I think in all these things, there were relatively minor issues, in the larger picture they were minor, but at the ground level, especially in the microfinance portfolio, they were troublesome. In the ECLGS scheme, because we do group lending, some of our customers were agree and some of our customers were non-agree in the same group. But the ECLGS scheme was specifically targeted to non-agree customers. So we had a situation where we could do ECLGS loan for some customers in a group, but could not do to some others. So it broke the group harmony. Similarly, in the restructuring program, we had a similar issue on agree being covered or not being covered, and therefore you use a different policy for that. So therefore, there could have been a little bit of microfinance tuning, for some of these programs, which are typically done in a group. And when you look in hindsight, in the wave 2, although we felt good about the fact that there was no moratorium, because we really wanted to let the normal environment continue, and on a best effort basis, we service the customers and we sort of collect the installments so that we do not have a major dip and we are trying to recover a smaller problem later. I think a special program just for the April, May, June EMIs, maybe post facto, after the effort has been put in, could have been done, because microfinance institutions typically, including the small finance bank portfolios and the MFIs themselves, saw a very significant dip in the collection efficiency just because of lockdowns. And once they have become either delinquent customers, to Jana, to Ajay's point, or they have become restructured customers, the norms are very different in terms of what we can do more for them, and the options become limited. And for the group lending model, for the microfinance model, a little bit of a different philosophy on April, May, June for the customers who missed EMI or two may have been a little helpful in solving the group dynamics that we continue to experience because of that phase.
Okay, thanks, Rajeev. So, yeah, these are suggestions. What has already been done by the government and RBI, we know. So let's come out with suggestions. Alok, now you come in. Yeah, Alok.
Thanks, Tamalda. I think, as you said, I would go with two basic things. First is, as I said in my opening remarks, that the SFBs beyond microfinance are lending into the most difficult customer segment, which the traditional financial system in India has not been able to crack, whether it is the NBFCs or the main banks, which is 2 lakh to 10 lakh segment, which I typically roughly say. So in that case, I echo Baskar's point that if some sort of a meaningful guarantee scheme can also be given, that would be very helpful. That is my first suggestion. And the second suggestion, to keep it brief, is that the recent, on a segment which is below 3 lakhs, I would say, which is also concentric with the microfinance segment, the registration requirement which has come in kicked in with the Udyami Mitra thing, wherein everybody is to be classified under whether it is a tiny or micro enterprise, has to register under Udyami Mitra. That needs to be, we are not against the policy intent. I would not say that formalization is bad, but you need to give a longer timeline. There are customers running into crores, 6 crore customers, both MFIs and SFBs have, and they don't have access to so much of digital literacy. It will take time. So if that can be relaxed, otherwise this typical flow, in our earlier remarks, I said that the contribution of the SFBs to the micro and small has been humongous. And that contribution, if they are not able to classify under MSME lending, that will be a challenge. So give a longer timeline for Udyami Mitra registration also.
Okay, Vasu, now for your suggestions, what else do you expect from the government and RBI? And after Vasu, in case I have some problem, Samit, you will continue. Yeah, Vasu.
Okay, okay, yeah. So yes, the background is that RBI and the government have done a lot of things, and that's why we are still smiling and able to talk. So that's very good. But what I also feel is that fundamentally, it's not just this COVID crisis related management, but fundamentally, the business model of an SFB regulatorily is designed to be very different from a universal bank's model. So what are the guidelines which cover an SFB compared to universal bank is exactly the same, except that in many places it's tighter. It's not linear, or it's not more lenient, or it's not more relaxed. It's actually tighter. So it's as if, we are being punished or penalized by having a tighter regulation on some areas and exactly the same regulation on all other areas. So I think what is important is that, RBI and the SOBs, I think we should sit together. We have an association of SOBs also. So we have a forum, ready-made forum through which we can, dialogue. So I think what is really important is a very serious level of discussion between our association and the regulator, where we can sit and see all of us come with huge amount of experience. Every one of us come with a very large amount of experience of dealing with this kind of borrowers. And so what is really required to, as a regulatory framework, both for COVID related as well as even on an ongoing basis, what's a regulatory framework required, which is actually the most appropriate for the profile of the customer that an SFB is serving or required to serve. So I think that's really important because, for example, this Ujjivan portal registration that URC that Alok was talking about, I mean, see, we are struggling with it. We are seriously struggling with it because 25% of my book is commercial vehicle financing. And in commercial vehicle, we are basically dealing with the used commercial vehicle. A driver who is wanting to become a owner, he is just putting 50,000 and borrowing 3 lakhs to buy a second-hand vehicle. So he is not eligible for any MSME benefit from the government: capital subsidy, interest subsidy, technology upgradation subsidy, import subsidy, export subsidy. He is not eligible for any subsidy from the government. So he is not at all concerned with registering himself as an MSME under URC. But I need him to register, otherwise it becomes non-PSL for me. If I lend this 3.5 lakhs to him, it becomes non-PSL for me. And I need his PAN number. He doesn't have a PAN. So I have to make him apply for and take a PAN. And his telephone number quite often is not the same as what he gave in Aadhaar. So I have to go and make him change the telephone number in Aadhaar and then get him registered and under URC and come back. Now the point is that from a competition perspective, banks don't fund this kind of profile. Banks are not in the segment at all. So they are not there. And the NBFCs are funding. NBFCs are not concerned about MSME registration or URC registration. So, I'm stuck with that. I need a registration under URC. The NBFCs don't need it. So it's just complicating our lives more and more, just these regulatory changes. So I think it's very important that, we should sit with the regulators and have a very free and frank and, kind of a guards down dialogue. And all of us can put all of our concerns on the table. Regulators can put their concerns on the table. And we need to work out something which is a real model. See, we have now been in a 5-year industry. I think it's time to take a kind of a review and say what kind of a regulatory framework is most appropriate going forward.
Thanks, Vasu. Thanks. Very, very, I think, important suggestions. Samit, yours is the last one.
Yeah, I just want to again reiterate that, what RBI has done in terms of liquidity, or the government has done in terms of liquidity, was very helpful, etc. But as we mentioned earlier, for our customers, their working capital has been wiped out during this COVID period, and for them to revive their business, they need additional capital. So there should be a way where we should be able to facilitate that, for the economy to revive. But from a regulatory point of view, I think there's not much. All I can say is, despite all these crises which we have gone through, a lot of the timelines which the RBI and other regulators hold us to, there is no leeway, You have to go public by so and so date. There is no issue about it. I think there should be some, consideration. I don't know if it is time that everyone can go and list themselves right now, in this market. The other issue which, we on the reverse merger side is facing, as Vasu has this thing recently, all of us are required that 25% of our it will be publicly held before we can move forward, right? Whereas when we reverse merge, it is all publicly held. So iska logic kya hai, hame to malum nahi, right? So, but we are being told, no, before you move forward, you go 25%, have it publicly held. No, I think there needs to be some kind of thought process in that. I don't know, Vasu is smiling. Maybe Vasu can add a few things, or I'm being too ambitious or controversial.
Okay, thanks, Samit. Now I want to come to a very exciting, interesting round, and we'll have to have one more round after that if you are really quick. The big elephant in the room, the technology, the digitalization. So things have dramatically changed. One of you said that things are happening faster. It's not faster. Faster is an understatement. It's happening at a breakneck speed. I think Nandan Nilekani somewhere said things are happening in weeks, which would have taken otherwise months or years. So tell us, how serious is this? Because now buy now, pay later. Even, consumption look like biryani from Zomato, I can order 2,000 rupees, I can split into 5 EMIs, 400 rupees each. And this is like your segment, the small borrowers and all. There are fintechs and tech things. We are into your thing. So how real is the digital threat, the digital disruption, and how you yourself internally, I'm not talking about the industry, as an individual, meaning at one particular entity, how are you preparing yourself for this digital disruption? I'll start with Ajay.
Thanks, Kamal. I think two parts to the answer. One clearly is our own digitizing for our customers. I mean, I mentioned it earlier that you can't do 1.5 to 2 lakh loans of 25,000 rupees each a month, and if you're paper-based. So I think being a digital MFI turned into a bank, and then carrying this whole digitization journey through and through. And that's really now the platform which everything works on. Even our secured business move a lot more digital. So it's all real. There's a lot of work to do. It's not we have arrived there, but I think that's really the 99% focus is as much digitization as possible. and the backend being as robotized as possible. So I think those are the two big elements which are working. I think the second most important element, which I think all SAPs enjoy now, is there is a whole fintech world opening, and there is no real worry beyond a point. I think we should all collaborate. I think fintechs are opening experiences and meeting needs of customers which typically are closer to the financial sector arena, not necessarily in the financial sector arena. I'm talking of fintechs which are really in the payments business, for example, or in the supply chain business. They really can be real collaborators for us. So really working with them, opening our APIs, making sure that you end up being partners. So I think two key elements. We will have some competition from the unsecured lenders. But like you said earlier, and I think most of us are focused on, is to grow bigger the secured book. So frankly, that is not an area which you worry much about. Since Tamal is left, I will pass it on to Vasu.
Okay, thank you, Ajay. Yeah, so digital, yes, you're right. In terms of three, I'll put it into three components: assets, liabilities, and the back office. I think assets and liabilities, most of us, we are fairly, kind of highly digitized simply because of the level of transactions that we have been always handling. And if you see on the liability side also, the time we all took to convert our savings account onboarding from paper-based to a tab-based, I think the time that we all took is probably a record. Compared to even some of the larger private banks who took probably longer time than us. So because it's there in our blood, and we know that to handle large volumes, we just need to have a lot more efficiencies available to us. And this collaboration stuff is still out there. We don't. See, the point is that we have the RBI guidelines, various guidelines of RBI, which have certain clauses in it. But they are drafted at a time when the fintech collaboration was not really available as an option at all. So you are really not very clear exactly what is okay, what is not okay, and you think something is okay, you do, something is not okay, you don't do, someone else is doing it, you are wondering whether you're missing the bus in that. So it goes on and on. And I was just reading a draft, a regulation which is put out by US Fed. Exactly on this point between bank and fintech tie-ups, they put out a discussion paper in terms of what should be the framework for the banks to tie up with fintechs in the US. So that something like that is probably what I'm sure will emerge in India also, which will put a lot of things clearer to all the players. And till that kind of a thing comes in, yes, so it's a kind of experimentation stuff that one has to keep doing. But as even the DG of RBI has been mentioning in some of his public speeches, I think it's a given that the fintechs and banks will have to work together. And that's what even the DG has mentioned in some speeches. So I believe that that's a way forward as to how we do it and how much we collaborate and where we collaborate, how we collaborate, what are the terms, is something that each of us have to find out. But I think it's also critical for each of our own perspective that through this kind of a process or arrangement, we don't really end up becoming simply a back office. Ultimately the client ownership, the ability to meet the clients, contact the clients, cross-sell our other products to the clients. I think if we are not able to retain that, right, then I think we may be bartering away too much from our side for whatever benefit that we believe we are getting. Thank you.
Thank you, Vasu. Baskar, over to you.
Yeah, I think all low-income households' behavior broadly is kind of dependent on what is in it for me. And many times it happens very slowly and then it suddenly happens. So we look at our own size of our industry. Pre-Andhra crisis, it was approximately 20,000 crores. It came down sharply to probably around 15,000 to 12,000 crores. But from 12,000, it went to 2,40,000 crores in a matter of 10 years' time. So I think it repeats itself in quite a bit. I think in digitization also, why this did really accelerate COVID, I would say that even without COVID, probably the acceleration would have been much faster than it is happening across. So slowly and then suddenly, I think is a repeat which we have seen quite a few times. The only difference between going digital for the rest of the banking segment and to the low-income households is that you can do all, as Vasu said, in terms of opening an account, giving a loan, and so on. But like imagine a situation like this COVID happened, it didn't really impact the general customers, banking customers who are taking a home loan, car loan. It did really impact our customers substantially, and we don't have a backup in terms of collections, which will take care of this meaningfully. There is no way you can really program. So to that extent, part of that will continue to be physical or in-person touch points. So that's a mix and match that we have to do it. From a partnership point of view, overall, I think from a markets that we operate in so large, from a dog-eat-dog world kind of a situation, say, which existed, whose customer it belongs to? I don't think the customer belongs to any one entity. He belongs to where he gets the best customer experience. So it then goes into a model where a crow feeds a crow. So you kind of do it in group, but you're all much better. So I think that's what we will see. The trust factor in partnerships has substantially increased than would have been 5 years back. I think there's no question of who owns the customer. The person kind of who gives the best customer experience is going to own. So it is shifted from competition centric to certainly customer centricity. And that is where, if done well, the newbies will have substantial advantage over the incumbents.
Okay. I can see Samita enjoying the discussion. So, Samita, yours?
So first thing I wanted to tell you that banks in general, not just us, and across the world, are the lousiest users of technology, I mean, we've used technology, I mean, we don't know how to manage technology, right? And fintechs are a very serious threat, right? It's coming up. And moreover, we are tied to a lot of legacy systems, which makes us like a elephant. And the elephant is not agile and cannot dance, right? So I think the solution really lies in doing tie-ups, tie-ups with fintech institutions as far as possible and trying to become more and more agile. I don't know how everything will pan out in the final phase, but definitely, fintechs are a threat to us, But fortunately for us, we have RBI, so RBI protects us from a lot of these threats, actually, but I think the way ahead is doing tie-ups with fintechs and as far as possible become more and more agile.
Okay, Rajeev, you?
Basically, as Samit said, that I think technology in financial services is now a given. Now, whether it is delivered by banks or they're delivered by specialized players, that's the only choice. And what will banks do and what will the fintechs do? Secondly, there's a two sides of the coin. One is the customer experience side of the coin. The second one is the product side of the coin. And I read a very interesting article recently that the fintech revolution is not necessarily just about the customer experience. It's actually about the product also. And like you said, Tamal, like buy now, pay later. That's not just experience. That's a product in itself where a customer can get funded at the point of the sale, even for small value transactions. This did not exist at an earlier stage. So you cannot just make better customer screens and attract customers unless you have the right product. And in the financial services world, a product wins along with customer experience. So what the new technology players are effectively adding to new products. Now, players like ourselves are somewhat in a middle position where we do not have such legacy systems and such legacy technology that we cannot really adapt to the new technology and the new way of thinking, and that's exactly what we are doing. And also the fact that the second advantage that we have, I will call it the moat of the business model that we operate in. A lot of us are in a very deep rural, paper-based or even a digital, but touching the customer, a high-touch model. And so in our current business, from a fintech revolution perspective, there are some moats out there. Samit talked about the regulatory moat, but the way we think is that as a bank, you should be in a best position to offer the best digital solutions to the customers that you want to service and the products that you want to service. And beyond that, it is all about partnership. But again, to Vasu's point, clearly, there is no real big win in becoming a back office. You need to retain your rights and be able to sell your products and own the customers in this revolution also.
Thanks, Rajeev. I am not. Yeah, please. Please, Savita, you want to share?
Our real wealth, this thing is really our customer database, and the customer information which we carry, right? But because analytics, along with the digital systems, are going to be the key, right? but analytics is driven by data, and the data, customer data we own. In fact, our net worth is really the customer data. But one thing we need to work on it to clean it up and make it usable, and work on the analytics side. I think focus on the analytics side and invest on the analytics side. I think that's very important. But that's our wealth.
Okay. Thanks, Samit. Alok, I'm not involving you this round. We are going. We have 13 minutes left. So let's see how much you can go. Now the next round, which is starting now, is each of you have very different questions related to your business. And this I'll start with Alok because you represent the industry lobby. Is this? There is certainly it had not been the case, but for the past 6 weeks or 2 months, the corporate governance is in the limelight. I know when it comes to talk about SFBs. So how critical it is from you, Alok, from MFIN's point of view, how critical, I don't want the theory which all of us know corporate governance is extremely good and all, but tell us something. You think there's some violation, there is certain issues, and how do you do about it? Quickly, sir, 1.5 minutes each.
Okay. Thank you, Tamal. First of all, I'm not from the industry lobby. I'm from industry association. Lobby is a little pejorative. We don't lobby first. Okay. Now, corporate governance, yes, definitely very important. I will not make mother statements. But I remember 3 years back when I was writing the State of the Sector report, and we had SFB roundtable in CAP Pune. At that time, the then Deputy Governor Vasudevan also had talked about this corporate governance and saying that we will be very tough on SFBs, you have to be do and all that. But if I look at from my perspective, when I look at the scan of SFBs, at least the SFBs I know as an industry association who have graduated from MFIs, I don't see any red flags on corporate governance, to be frank. Let me be very blunt about it. And if you see, and if I compare it with the corporate governance of the so-called big banks, whether it is the public sector banks or private sector banks, I think the corporate governance in the small finance banks is not a notch lower. And that again, I would like to repeat, while for some, promoter is a bit of anathema with corporate governance. Sometimes, many times in theory, when we teach corporate governance, we always say that it should be professional run, it should be, if it is a promoter, and as Samit was talking, dilution and all those things. But I think in case of SFBs, the classical textbook theory cannot be applied. You also have to look at their business model and see the track record of the promoters who are involved in the corporate governance and the legacy which they have created, their commitment and passion. And to end it all, I don't see any red flags. It is very important. It will remain important, but I don't see any red flags.
Thanks, Alok. It's good to hear that. Baskar, question for you is this. A few weeks back, you were in the news, or rather, meaning your bank was in the news that you are taking over some big NBFCs and all. So now, since this subject today, we are talking about how the small finance bank will make it big. I think, is this your way of making it big because you are adequately capitalized through acquisitions? Can you take us through? What's your plan?
So I think either organic or inorganic, I think each one of us will keep looking at the opportunities. But what's really important in terms of any such opportunities, even if it is organic, getting into a new product per se and want to build scale, is that it has to really fit into your model. So you kind of keep looking at it. Beyond that, I won't really be able to say anything on this.
Baskar, more like a stock exchange notice that you have given now. Okay. Basu, when you started, I think you were one of the very interestingly poised organization where 1/3 auto loan, 1/3 personal loan, etc. So where in terms of assets, composition of assets and liabilities, if you can tell us.
Okay, currently we are at about 18% microfinance, 25% commercial vehicles, 45% is small business loans which are backed by collateral securities, and 5% is SME and 5% is NBFC lending. So that's how our assets are spread out. Deposits, CASA is about 45%, and the total deposits is about 80%, and retail deposit, within deposits, retail is nearly about 75-80%. The remaining is borrowings. So that's
okay.
how it is.
Basu, you are also the first SFB, I think, using Google Pay to raise deposits, right? How is the response?
So that's something that we would really not be able to comment upon at this point in time.
Okay, fair enough. Ajay, are you there?
Yes, Tamal.
Yeah, Ajay, Vasu's composition, we have had 18% microfinance, etc. I was just going through the Jana numbers that your unbanked rural branches are more than 20%, 25% more than what RBI wants. So can you tell us, I mean, have you been able to build a portfolio beyond microfinance? What's the product composition and what's the urban-rural part of it?
Right. So Tamal, we took two steps when we turned into a bank. First, we said we will grow secured business. And second, we will set on a microfinance, we'll move and balance our books towards an urban and rural divide because we were largely an urban microfinance company. So on the secured side, we are 40% secured as of March. So we have moved from the 5% to 40% in 3 years. On the rural side, again, we have found that there is, most people worry about unbanked rural branches because they're quite remote and there is not enough profit model to make that succeed. I think our focus on the dairy milk chain has helped us really break through that challenge. We're very happy growing unbanked rural branches. They're very well manned. They are profitable very swiftly. They also serve the local area very well in financial inclusion. So we find it very comfortable that our unbanked rural branches is actually 28 or 29%. And I suspect it'll always remain high because we have a very good model to really make that work.
Okay, thanks, Ajay. Rajeev, Fincare again has a very interesting history. I think 3 NBFCs joined together, and then that SFB created and all. Now, tell us what is your USP, how you are different from others, or you are just one of the SFBs?
I think we are somewhat similar. A lot of us are similar. But I think what we have sort of built on as some of our strengths are, we have been largely rural. So, that one we have been very focused on, and we are roughly 95% rural on our assets. The second thing that we have built on is a very strong technology platform right on one. And we do believe, we have some strengths out there. And the third thing, I think we started the journey a little earlier of bringing in a management team and a professional management team way before the conversion of the bank. So over a point, I think that has helped us position the bank also strongly in the market.
Okay. Samit, you are the last speaker, and you meaning Ujjivan is in the news for wrong reasons though, but you have been in the news. And I have to ask you a pretty uncomfortable question, but everybody wants to know, and it's up to you to answer or not. You are a listed entity. So what exactly has gone wrong or right, whatever? Because there is one segment of people who believe that your CEO had to go because it's not coming up the way microfinance should be approached, we should be run, because that probably was not happening, and that's why the gentleman has taken a call to leave. And there is other group which feels this probably he was not willing to leave, there's an interference, so on and so forth. So if you want to take us through what exactly, and you also had spoken initially, then of course you have not been talking of late. So if you can tell us what exactly, to the extent possible.
So it's a difficult question which you asked. I think, we were actually sort of caught in surprise when he resigned. And he said it was for personal reasons, so I cannot speak for him. But Tamal, I feel, the COVID crisis was a very serious challenge, and it required a kind of experience, to go through that, and maybe that was a challenge, which led to this. But I don't think there was any issue, other than that. I think it was a very difficult time, and Nitin was relatively new. He had no experience in this area, largely on the digital side. So it was a very difficult challenge for him to go through. And maybe if the COVID crisis was not there, it would have been okay.
Okay, thanks, Samita. So we have come to the last round, and after that we will take questions. 4 minutes left, 6 of you. So less than a minute each. I will start with Baskar and end with Ajay, and then in between all of you. Just tell us 2-3 sentences, the lessons learned from COVID, and if indeed COVID is behind us, is it like everything is full of optimism and confidence everybody talking about, both in terms of creating new loan assets and people paying back and newer products? Baskar?
Yeah. Quite a bit of a learning, Samit. Kamal. As Vasu said, the markets are large, so many kind of possibilities. Irrespective, I think a couple of things to kind of know out of this is that organizational learning takes time. I think in banking, it's kind of better to build irrespective of how great it looks, to be balanced, which means that how much our money we make out of, say, unsecured. It is time that on a proactive basis, irrespective of how difficult it is, move into creating a balanced asset side, same as in terms of the liability side. Sometimes some liabilities will be expensive, but they'll be sticky, they'll be granular, you have to really go for it. So the takeaway is that equally while you're acquiring more and more customers, the opportunities exist substantially in digging deep into our existing customers. That as an opportunity we didn't have as an NBFC MFIN. We have been given it on a platter. I think it's time to really utilize it and meaningfully grow. That's the learning out.
Vasu?
Yeah, so the COVID definitely created a lot of new stresses, which was not there earlier. Lessons learned from all that, of course, is whatever, we keep ploughing on and doing our job. But main thing, I think, is communication. I think it's very important that we keep communicating to the market, to the public, to the regulator, to the government, or to all our stakeholders effectively. Keep communicating, because that's what is the best way of addressing the issues. The issues will always be there. If not COVID today, something else may be there tomorrow, who knows. But if everybody understands what exactly is happening, then I think we have made everybody relax. So that, I think, is our biggest learning from the last 1.5 years. And in terms of going forward, I think, as we have been always saying, that SFB model is a great model. And so it's bound to succeed, and we already done very well in the last 5 years. And this 1 year stress, I'm sure, will overcome, and all of us will have a great time going forward.
Rajeev, quickly.
Tamal, I think very basic, simple lessons. I think diversification is key on any direction, on any parameter, to manage a crisis, be it a geography diversification, be it a product diversification, it is important. Second, it boils down to a good bank or a bad bank. Ultimately, at a broader concept level, gets differentiated on their credit portfolio in the long term. And so strong NPA management, which actually comes from how you lend in the good times and what kind of exposures you give to the customers, and not just go after growth, is a good lesson which was taught us from DMON. It has been reinforced in the COVID times, and we should take some learnings from there. The third thing is about the team. Generally an institution which has a stable team, which has the experience of managing multiple crises, their ability to rebound or to react to a crisis, solve the crisis, and rebound in a crisis is absolutely key. And the fourth lesson that we are drawing from earlier, and which is yet to follow, and which is the early signs are already there, is that after a crisis, the rebound, at least in the financial inclusion space, is phenomenal. It rebounds very fast. The growth rates are very good, and it is the best time to build a portfolio. So, some tough lessons, but fundamentally the opportunity which is going to come just after COVID is also going to be very good.
Alok?
Yeah, thanks, Amalda. For me, if I look from the industry perspective, 3 lessons for me, why the sector has survived, including the SFBs. One, the importance of client connect. Before that, we were seeing a weakening of client connect, but now it has come back to it that client connect is very important. It has to be there. It cannot be, everything cannot be digital. Second, the importance of employing digital means in such disruptions in reaching the client and improving the product offerings to the client. Third, and the most important, I think, is having an adequate level of capital buffer and a very prudent provisioning policy, rather a conservative provisioning policy. I also remain, because with the vaccinations crossing 100 crore mark, and hopefully by 30th November, if there is no other major spread, we should be up and dry. And the future remains bright for the economy to grow, provided there are no disruptive macroeconomic changes or public policy changes.
Ajay, over to you. The lessons learned from COVID and the way forward.
So the first most important lesson really for me was the employee side. I think in moments of crisis, employees come together and really hold the bank well, hold customers well. And I must tell you that in this crisis, the one thing which always was a strong support and showed us that we will get out of it was the way the employees rallied and supported everything, right from helping community activities, helping the police, helping distribute food, and yet do their jobs, keep the branches open. I think real solid learning, I must say, and unforgettable in every manner. I think second is there is no price for prudence. It is invaluable. Yeah. Prudence on capital, prudence of where you do risk management, prudence how you provision. When you do that in good times, one wonders that why would you want to be a bit more conservative? But you will never define when the bad time arrives. And the third piece is, the digital journey, which all of us began, is now, from a average car, it has become a race car. And we have to now navigate a race car. Those are my three learnings.
Thanks, Ajay. I think it's pretty interesting and engaging discussion. We could have gone on and on, but we have already exceeded our time. So, and we'll take a few questions. We can't take so many. I'm flooded with questions. Sachin Mampata of Business Standard is continually sending me. But before that, what are the key takeaways? I think the one word which summarizes everything is the resilience of the resilience of the small finance bank. That's what. So it's not the challenges. Yet there are challenges, but all of you are looking at the opportunities. I think nobody is saying that, well, we'll give it up. Even if the third wave hits us, I think you have put your house in order, you have learned the lessons and the way forward and making it big. So indeed, small finance banks are dreaming of becoming big. I can see Mr. Gandhi patiently has been with us, and you will be happy to know, Mr. Gandhi, this gentleman called Rajeev, he is the veteran in this professional in the financial sector, said that SFBs should be, it's a comment, not a question. SFBs should be effective instrument of financial inclusion. One second, sir. SFBs should be effective instrument of financial inclusion and not aim to become a universal bank. They are expected to fill the void left by the commercial banks. I go with Mr. Gandhi. So that's what pretty good to hear. Now the one question is this. I don't know who wants to take that. M. Vasanta Krishna. How well placed are SFBs to maintain their good performance and low NPAs as penetration deepens? It's nothing to do with COVID, but generally how, as you spread out more, penetration deepens, how do you protect the asset quality? Anybody? Vasu, I don't know who is the more penetrated entity, or Samit.
See, generally, if you take the pre-COVID, if you take the pre-COVID situation, as Mr. Gandhi was making in his presentation, the GNP of the small finance banks at around 1.8 or something that he presented, 1.8%, was the lowest amongst all type of banks, including the private banks. So I think the model is already proven model. I don't think we have to go out and we'll be required to prove all over again. The COVID has impacted, it's all gone up, but it has to come down. It's a question of time. And once that comes down, then I think we have historically proved that we are actually much better in terms of managing asset quality than any of the other segments of the banks.
Savita, you wanted to add anything? No. You're on mute, sir. Okay, fine. Yeah, this question I would like Mr. Gandhi and Alok, maybe 1 minute each, less than a minute each and on, because others are all interested parties, they have vested interest. Would you expect consolidation in the SFB space, perhaps through mergers and acquisition? Mr. Gandhi?
Consolidation within the SFB, that's the question.
Yes, because we know at least one SFB is extremely weak, that everybody knows. I'm not naming that entity. Okay. Very small and very weak and all. So this is a relevant question, I would say. Yeah.
Okay. I think Baskar Babu did mention that it is always an option for a commercial entity to think about organic growth or inorganic growth or whatever. Whenever the right opportunities do come, that particular institution could think about inorganic growth also. So we will not rule out that possibility, but because everything depends upon the commercial situation based on which such decisions will be taken. Whether it will be good for the sector as a whole for any such consolidation to take place, so long as they remain within the small finance area, it is okay. That's what. Okay. That's what I would say.
Alok, the question is from Aninda Ghosh. Yeah, Alok.
Yeah. I think taking an isolated case, and that too because of an extraneous situation, and then saying that because of this there would be consolidation. From my personal field, not as the head of the industry association, I think the time for tie-ups with other agencies like fintechs and others is there. But I don't see in the immediate future, or I think down 2 to 3 years, that is a little bit of crystal ball gazing, consolidation within the SFBs. I don't see it.
Okay. The same gentleman asking one more question, maybe Ajay, if you want to answer. How major is the threat of competition for SFBs among talk of privatization of public sector banks and potential entry of big corporate houses into banking?
So I think Basu mentioned it earlier, and folks, I think 60 to 70% of India are segments that SFBs can address. SFBs have been started purely because financial inclusion was not meeting the goals that was required to be met. So I don't think so for us, growth is a challenge. We have enough and more to do. And I think all of us are doing it in very different pockets. So I'll take one more second or a few more seconds, Tamal. See, there is a different way we can create risk models. We have different channels we are approaching. There are different service models we are doing. There are different ways we are bringing things like insurance, which is literally not available in the segments that we service. So the market is massive. I think it is for us to manage our growth well and grow in a balanced way. But I think growth by itself, I can tell you that none of the SFBs will feel challenged in any given year for many years to come.
Okay, there are many more questions, but one question I would like to ask, I think rest of you, I mean, Rajeev, Shamita and Baskar, three of you can answer separately is this. He's saying that this gentleman is Hey Ehud. He's probably a little cynical about your internal checks and balances and controls. It's how comfortable you are with your internal control, because there is the digitization is limited. You depend on manual processes which are not always dependable, etc., etc. So it talks about this, your risk management, your control, and your lack of digitization. First Baskar Babu, and then Rajeev, and then Vasu. You will be the last speaker.
Not sure, just because not sure where this is coming from, Tamal, but probably just because of moniker small finance bank, it is not that we are nowhere small in terms of technology or in terms of controls. As Vasu also previously explained, if at all I think what the tighter regulations have done has been good for the industry. As light touch regulation does not preclude us from any of the systemic risk. I think while there is a pain on one side, there is a substantial gain on the other side that we kind of, as we build the institution, I think the systems and controls that I think is also reflected by the fact that has there been any instances where any regulatory or control breaches have been reported or any of the SFBs have been criminalized? To my mind, I think the answer is zero. Just because you're a small finance bank does not really mean that you're small in controls, processes, or digital for technology. Nice talk. Yeah.
Thanks, Babu. Probably there's a misconception, so it's your responsibility to put it in perspective, the right thing. Rajeev, over to you.
Very simply, I think we have done it. It's not technology helps us in multiple ways, like eKYC. Our KYC are strong. We know exactly who has taken our loans, who has opened the accounts, right down to the village level. There cannot be, misreporting or misuse of that opportunity. Our touch points might be greater, but when it comes to the critical steps of the process, they're all centralized. They are digitized. There is so much controls built in. So I would say small finance banks are very tight on their controls and overall processes.
Okay, the gentleman, hey, Ehud, you are listening. They are not buying your stuff. They are saying they are absolutely as good as any other big bank when it comes to risk management and internal control and digitization. Vasu, you have the last word.
Yeah, so things are changing. The way bank operates is changing, and I'm not really talking of the fintech wave and all that. Even I'm saying minus the fintech also, the way banking is done has changed substantially. I mean, for a new bank like us, 98% of our transaction happens outside the branch, and that is within the first 2, 3, 4 years of our operations. And I remember large private banks used to have something like 70-75% of that after more than 15-20 years of their being in business. So even minus the fintech wave, there's a lot of change which is happening today. And in fact, one of our internal meetings, we were even saying this whole concept of branch audit. Is it the way that branch audit has been done all these years should be done again today? Because the branch itself is not the same as what it was before. Today, we know exactly what's happening in the branch. Earlier, what happens in the branch was known only to the branch people. The records were maintained only at the branch. No one outside the branch would know what exactly happened inside the branch. So you have to send an auditor to go and sit in that branch to figure out what's happening. Today, everything is centralized, everything is automated, everything is monitored centrally, everything can be monitored centrally, everything can be supervised centrally. Then if I know exactly what's happening in a branch, do I need to go and sit in the branch to do an audit? So the way banking is changing is very, very, very significant. And I think that's a great opportunity for all of us, because the more you are able to control and balance things out, in any form of a centralized and digitized form, you are trying to save cost somewhere, which becomes a benefit for all the stakeholders concerned. So clearly, I think SOBs are in a sweet spot, I would say, because we are all coming with a new mindset. We are not having the old mindset. We don't have legacy systems, not only computer systems, I'm saying legacy process systems itself. We don't have. Everything is new, and we are absolutely open to change.
Thanks, Basu. And may I now request Mr. Gandhi, you started with your keynote address and a lovely presentation. You heard them through 1 hour, 15 minutes and all. Why don't you have literally the last word? Just a minute. We are short of a minute. Just tell us what you heard and how do you react to this? Can they make it big? Can they make it big?
Yeah, and you had actually put it very, very in a single word: resilience. That's very great strength of the SOPs. They had, as a microfinance institution, they had passed through the crisis of 2010s, and in the recent period as SOP also, they have been tested on 2 major events like demonetization and now the pandemic. So every time they have come out well, and the level of quality and attention to monitoring with the help of technology, that is what is giving the basic strength that this set of institutions have, and that is there to be there for a longer time. As Ajay did mention also, scope is always available. If you only set your hearts to go behind that, you need not worry about competition, big, small, diversification, or privatization of big banks, and I think nothing is going to be disturbing an SRB's scope of activity. That's what I think.
Thank you, Mr. Gandhi. So that brings us to the end of day 4 of Business Standard 11 episode 9-day Big Bang BFSI Summit. Over to you, Manish.
Thanks, Tamal, and many thanks, Mr. Gandhi and all panelists for your insights. Thank you again, Jana Small Finance Bank, our partner. And dear audience, as Tamal said, we are not even halfway yet in the Business Standard BFSI Insight Summit. The sessions coming up are on your screen. We discuss FinTech this Friday at 4:30. On 2nd November, we are discussing bank privatization. We take a break for Diwali and come back with a bonanza back-to-back sessions on November 8th, 9th, and 10th. All of these sessions start at 4:30, except the one on 10th, which is at 4 p.m. Hope to see you there. That's all for now. Have a great evening. See you on Friday.
Thank you. Bye.